Well, let's get back to the big economic story in this country today. It looks like we're starting to run out of some steam in Canada. We now have an early look at how the first quarter played out. New data this morning from Stats Canada suggesting GDP was basically flat in March. Meantime, in February, growth of 0.2% fell short of economist expectations, and the expansion in January was revised lower, pointing to overall first quarter growth of around 2.5%, which would be slightly below the Bank of Canada's own forecast. And while the numbers don't suggest a sharp downturn on the horizon, this data, coupled with signs of easing inflation pressures, could be building the case for an interest rate cut in this country as soon as June. Ahead of these numbers, many Bay Street economists were already expecting that a 25 basis point cut could be coming by the bank's June meeting. That would kick off an easing cycle in this country at a time when interest rate expectations in the U.S. keep getting pushed back. For more perspective on all of this, let's talk to Dennis Mitchell, joining us here in studio to talk a little bit more about how he's approaching the landscape. He's CEO and Chief Investment Officer at Starlight Capital. Dennis, good to see you.
Good to see you too.
If you were to characterize the Canadian economy and use today's data as sort of an added contextual piece, what would you say right now?
Definitely slowing. But, as I was walking over here, I was trying to figure out, okay, GDP growth has now gone 0, 1%, 2.5%. But if we dig through it, there's clear evidence of a weak economic outlook, right? I mean, businesses are investing less. Tough to grow your earnings if you're investing less. Household savings rate has gone north of 5%, so tough to see, significant ramp up in domestic consumption if households are saving more. And we know, of course, we've got a wave of mortgage refis that are going to put downward pressure on consumer disposable income. So when I take it back to the GDP number, yes, it's low, below potential, below trend, but it's actually more than twice the last reading. So it's tough to get a picture. I think what I'll say about this, John, is that economic growth in this country is weak. Interest rates are likely to come down, starting with the Bank of Canada in June. But I do think we're probably going to miss a recession. And if we do get one, it'll probably just be a technical one and not very deep and not very long. So a little bit of Goldilocks, if you will.
And I guess the question for a central bank in making a decision on when you want to make a move on interest rates, I was talking to an economist yesterday that suggested Tiff Macklem is more of a dovish central banker. In other words, a lot of his language has suggested that the bank wants to move towards cutting rates, even if there's enough Goldilocks out there that maybe justifies not making a move as soon as, let's say, June.
Well, I think the mistake that a lot of people in my shoes make is they talk their book, what they would like to see central banks do, as opposed to what central banks are likely to do. So in my instance, what I try to do is actually just listen to what they say.
Yeah.
So Tiff, when he spoke to Parliament, said he's very concerned with the housing market, specifically the refinancings. He has told you that the conditions, the trend that we're seeing is appropriate to start cutting rates. He just needs to see more of it. Well, this morning's GDP print was more of it. So rather than trying to insert my own sort of, this is what you should do, listening to what they are talking about, it indicates that they think rates are too high. And by they, I mean Bank of Canada and the Fed. They think rates are too high, that they are putting downward pressure on GDP growth and potential, and they would like to cut rates. The question is when. So clearly the Bank of Canada's got more ammunition in the short term to start cutting in June. It looks like the Fed would like to cut in June, July. Maybe not. But, if I were a betting man, I would say the Bank of Canada in June for sure, the Fed by September, October for sure.
Yeah, it's because there's been a lot, sort of growing chorus of people who are now sort of even trying to take rate cuts off the table in the U.S. for the year overall. But the divergence, at the very least, if it's Bank of Canada first and eventually Fed, you are seeing that play out in our currency story. Even today, I'm seeing more weakness for the Canadian dollar against the American currency. And I wonder how you think about that dynamic, just the struggles for the loonie.
Right. So I'll actually take a step back.
Sure.
If you look at the last 2 months of 2023, when markets started to price in 6 rate cuts for the Fed in 2024, the Canadian dollar actually soared versus the U.S. dollar more than 4% in that short 2-month span. So being off 3% and change year to date still doesn't equalize to where we were before sort of that spike. So that's one thing to keep in mind. And then extrapolating and looking forward, if the Bank of Canada is going to cut sooner, then yes, that would theoretically put more downward downward pressure on the loonie. I think the Bank of Canada is probably going to cut sooner and by more. So I don't see a lot of sort of upward momentum for the Canadian dollar versus the US dollar from now through the end of the year.
Well, let me go back to that housing market worry that Tiff Macklem seems to be highlighting. You talked about that. And we have a different mortgage cycle in this country, and that's often used as the comparison between Canada and the U.S., where if there's a little bit more flexibility for the average mortgage holder than here in Canada in terms of the sticker shock of higher rates, you might be willing to spend a little bit more. Maybe there's a more resilient consumer. You talked about saving levels by comparison in this country. When you look at the housing market and the dynamics to watch over the next few years, what nets out for you?
The extreme imbalance between supply and demand. Again, nobody says interest rates are low, we should go out and buy a house, right? And and on the other side, nobody says, we just had 2 kids, twins, but rates are too high, we shouldn't buy a house. So interest rates just impact how much house you buy, where you're able to buy that house, but it doesn't change the actual decision. So again, I come back to this extreme mismatch between just overwhelming demand from a demographic standpoint, driven by immigration, and a dearth of supply. We build 250,000 housing units a year in this country. We need to be building closer to 400,000 or 500,000 to fill that supply-demand gap. We're just not seeing it in the short term, and it remains to be seen in the intermediate if the government's housing plan actually has a positive impact on housing supply. I hope it does. Find some wood to knock on. Here we go. But I'm a little skeptical. So from my own standpoint, I've got 2 kids who just recently purchased homes, and I don't think either of them plan to purchase homes way outside of the GTA that they were forced to because of interest rates and housing prices. I don't see that letting up anytime soon.